Hi, I'm Adrian. Welcome back to Premium Logic Lab. Big tech is crashing. Amazon and Microsoft just entered bear market territory. Over $1 trillion was wiped from the Magnificent Seven in a single week. It was the worst week for these stocks since the tariff shock last April. And if you open any financial news app right now, the headlines are screaming, sell. So let me tell you why I think that's exactly the wrong move. Let's start with what actually happened. Last week, 4 of the biggest companies on Earth, Amazon, Alphabet, Microsoft, and Meta, reported their fourth quarter earnings. The numbers were strong. Revenue was up. Cloud growth was accelerating. Q4 earnings growth across the S&P 500 came in at 13.2%. But here's the number that spooked Wall Street. Combined capital expenditure for just those 4 companies hit $120 billion in one quarter. And their projected spending for all of 2026, close to $680 billion. That is more than the entire GDP of countries like Singapore, the UAE, or Israel. Amazon alone guided for $200 billion in capex this year, the highest in corporate history. Microsoft's infrastructure budget keeps swelling. Meta is pouring billions into its Llama 4 model, and Alphabet's cloud backlog hit $240 billion. The market looked at all of that and asked one question: when does this spending actually pay off? And that's a fair question. But the answer is already showing up in the data, if you know where to look. Google Cloud revenue surged 48% in Q4 to $17.7 billion. Microsoft's Azure grew 39%. Amazon Web Services is still accelerating. Microsoft Copilot now has over 100 million monthly active users. Meta proved that AI-driven ad targeting increased their pricing power by 6%. These are not companies burning cash on science experiments. They're building the infrastructure that every business on Earth will depend on. Now, here's the deeper issue that nobody's really talking about. The Magnificent Seven now make up roughly 1/3 of the entire S&P 500. 7 companies. 1/3 of the most important stock index in the world. Last year, just 7 stocks accounted for more than half of the index's total gains. The S&P 500 returned about 16% in 2025. Sounds healthy, but strip out those 7 names and the rest of the market barely moved. This concentration is so extreme that Vanguard and Fidelity have started adding non-diversification warnings to their index fund disclosures. Think about that for a second. The safest, most boring investment in the world, the index fund, is now being flagged as potentially risky. When a handful of stocks carry the entire market, everything looks great on the way up. But on the way down, there's nowhere to hide. Now, here's the good news. This is actually starting to change. The share of growth coming from the Mag 7 has dropped. The S&P 500 is up 1.9% so far in 2026, but the Mag 7 only contributed 0.8% of that. The rest of the market, industrials, financials, healthcare, is finally catching up. Analysts are calling it the Great Convergence. The era of blind faith in GPU clusters is over. We're now in the ROI phase. Companies have to prove that this AI spending generates real returns, and the ones that can prove it are being rewarded. Here's where I want to share my honest take. I think this sell-off is overblown. Not because the concerns aren't valid, they are. Spending $680 billion in a year should make anyone pause. But I believe we are in the early innings of a technology shift that will define the next decade. AI is not a fad. It's not crypto in 2021. It's not NFTs. This is a fundamental transformation of how businesses operate, how software is built, how decisions are made, and history tells us something important about moments like this. In the year 2000, Amazon's stock crashed 94%, from $107 a share to $6. Its market cap went from $30 billion to $2.2 billion. The headline said Amazon was finished. But here's what the headlines missed. Amazon had something most .com companies didn't. A real business model. A negative cash conversion cycle that generated cash as it grew. Real customers. Real revenue. Real infrastructure. Pets.com died, Boo.com died, Benz died. Amazon survived, and not just survived, it became one of the most valuable companies in human history. The same pattern plays out every cycle. The internet boom killed hundreds of companies, but the survivors, Amazon, Google, eBay, went on to dominate for decades. I believe we're seeing a version of that right now with AI. Not every company making big AI bets will survive. Some will overspend, some will misjudge the market, but the ones that get it right, they won't just recover, they'll emerge stronger than ever. And right now, the fundamentals are telling a very different story from the stock prices. Amazon is trading at half the forward PE of Walmart. That's not a broken company, that's a discounted one. Cloud revenue is accelerating across the board. Enterprise AI adoption is real. Microsoft Copilot alone proves that. The market is punishing speculative AI, but rewarding tangible AI. The sell-off is real, but the fundamentals haven't changed. What's changed is sentiment, and sentiment always swings too far in both directions. So what should you do? First, don't panic, sell into a narrative. The trillion-dollar headlines are designed to get clicks, not to help you make good decisions. Second, check your concentration. If your portfolio is all S&P 500 index funds, you're more exposed to big tech than you think. Consider adding international or small cap exposure for balance. Third, separate the spending story from the earnings story. Yes, capex is massive, but revenue is growing faster than expected. These companies aren't gambling. They're investing in real demand. Fourth, think in years, not weeks. The market is terrible at patience. That's exactly where your edge is. Every major technology disruption in history has followed the same script. Hype. Overinvestment, crash. Then the survivors emerge and dominate for decades. We are somewhere in the middle of that story. And the worst thing you can do is sell the future because the present feels uncomfortable. Stay rational, stay positioned, and don't let a scary headline shake you out of a decade-long opportunity. Thanks for being here. I'll see you next time.